today, stocks sink after rate hike. The waiting game for Dow 20,000 continues even after the Fed's Wednesday announcement of a rate hike as the blue chip stock gauge failed to hit the market milestone after flirting with history in the previous trading session. Stocks treaded water till the Fed's announcement of a quarter-point hike, which came 2 hours before the 4 p.m. at market close. The major indexes seesawed, climbing and then losing steam. The Dow slid 0.6%, down 119 points. It's about 207 shy of that never-reached 20,000 milestone. Down by a larger amount was the S&P 500, which shed 0.8%. The Nasdaq Composite lost 0.5%, 394 shares. The Dow, arguably the world's best-known stock market barometer that's been around since 1896 and which is made up of 30 of America's best-known blue-chip companies, climbed as high as 19,953.75 Tuesday before pairing some gains and closing up 114.78 points to 19,911.21. The Dow hitting 20,000 has a lot of resonance with people because it's such a nice, big, round number, says Chris Zaccarelli, Chief Market Officer at Cornerstone Financial Partners. It's a nice mile marker and should boost investor confidence. Recently, the Dow has been a recipient of the so-called Trump rally, a stock surge since Election Day powered by hopes that President-elect Donald Trump's more business-friendly, U.S.-focused policies will boost the economy and corporate earnings. Goldman Sachs, the Wall Street powerhouse bank, has been one of the biggest drivers of the Dow since Trump's election, as investors bet that lower regulations and higher interest rates will provide a major lift to the bank's profitability. Foreign stock markets were relatively quiet ahead of the Federal Reserve decision on interest rates. The broad stocks Europe 600 Index was down 0.3% and shares in Japan and Hong Kong closed relatively unchanged. British pound, New Zealand dollar, exchange rate gains. While GBP rates strengthened on Brexit comments in the afternoon, the pound sterling to New Zealand dollar exchange rate struggled to return to the week's opening levels. GBP/ENZ emerged from its worst levels by the afternoon as demand for risk-correlated currencies petered out and the Fed meeting approached. However, sterling still failed to make significant advances. This was despite comments from UK Brexit Secretary David Davis giving investors some confidence. Davis indicated that the government's Brexit plan could be published in February and that the government was still aiming to have a smooth Brexit that worked well for businesses. An unexpected rise in UK wage growth failed to improve the pound-New Zealand dollar exchange rate, with GBP/ENZ losses following unavoidable inflationary pressure fears. The pound-New Zealand dollar exchange rate has been poor so far today, with a loss in the pairing coming after the announcement of rising wage growth in October. In the wake of rising November inflation on Tuesday, this result was expected to boost pound demand, but has apparently failed to print high enough to counteract inflationary fears. Elsewhere, the UK unemployment rate in October remained at 4.8% instead of rising as expected, keeping it at an 11-year low. Another troubling aspect for GBP investors has been that claimants in November have risen by 2.4k, a higher than expected result on the month. On Tuesday, the pound spiked up to a rate of 1.76 against the New Zealand dollar, but closed down trading back at its starting rate of 1. California today, housing fight hits San Diego. The fight for more housing has a new war room in San Diego. Increasingly, even well-off professionals are finding they can no longer afford to live in the San Diego area. In October, the county's median home price was the highest in a decade, $507,500 according to CoreLogic, a data analysis company. Part of the problem, housing experts say, is simply a shortage of units that is driving demand. As the number of San Diegans has risen, new housing construction has failed to keep pace. And one reason for the lack of construction? The residents of San Diego. In many cases, housing proposals fail because residents pressure officials to reject them on the grounds that they would spoil neighborhood character. About 6 months ago, frustration over San Diego's inability to lift its housing stock led to the formation of Housing U Matters, a coalition that includes business, building, and environmental organizations. The group has raised about $50,000 toward its mission to break the housing impasse through research and advocacy. Mary Litton, the group's project consultant, said everybody needs to step back and think about the big picture. We have to come up with a story that connects the dots of where great cities are headed and what you need to have to be competitive, she said. Housing U Matters appears to represent San Diego's first formal organization of so-called YIMBYs, an acronym for Yes in My Backyard and a wordplay on NIMBY, or Not in My Backyard. For now, its numbers are in the dozens, much fewer than with longer established efforts in the San Francisco Bay Area. The San Diego advocates say they are challenging an attitude that flared during a recent housing battle in Poway, about 20 miles from downtown San Diego. A project was proposed to build 22 units of affordable housing for veterans on a vacant lot in town. At an emotional hearing on Nov. 15, several residents attested to their admiration of veterans, but many also denounced the plan. It would be an eyesore and a traffic nightmare, they said. Are we going to have any open land left in Poway? Tom Scott, a 40-year resident, asked the city council. Or are we going to build on it? The project was rejected with a 3-2 vote. Many of San Diego's YIMBYs are millennials who say they are fed up with spending upward of 40% of their income on housing. The older people, they already have their house, said Chance Shea, 28, who became a father last year. Now that they have their homes, they are saying, hey, I don't want a bunch of other houses built. I like my green space. The debate seems likely to grow more heated. By 2050, the San Diego region is expected to add nearly 1 million people who will drive demand for an additional 330,000 housing units, according to government data. Ms. Litton noted that much of that population growth is expected to come from families within the region. So, these are our children, she said. We have to figure out how to house them. Asian stocks, currencies wobble as Fed flags more hikes. Asian shares and currencies softened on Thursday after the Federal Reserve raised rates for the first time in a year and hinted at the risk of a faster pace of tightening than investors were positioned for. Yields on short-term U.S. debt surged to the highest since 2009, sending the dollar to peaks not seen in almost 14 years, which in turn prompted China's central bank to set the yuan at its weakest level against the greenback since 2008. The Fed's anticipated policy path and expectations U.S. President-elect Donald Trump will set growth on a higher gear are keeping Asian policymakers on edge as capital gets sucked out from the fragile export-dependent regional economies toward dollar-based assets. The Fed's rate rise of 25 basis points to 0.5 minus 0.75% was well flagged, but investors were spooked when the dot plots of members' projections showed a median of 3 hikes next year, up from 2 previously. The markets were surprised by the dot plots. Given that the 10-year U.S. bond yield has risen above the key level of 2.5%, the sell-off in bonds is likely to continue, said Hiroko Iwaki, senior strategist at Mizuho Securities. The change came even as the Fed's economic projections have hardly been upgraded, suggesting the Fed could accelerate tightening even further if policymakers see firmer evidence of higher growth or inflation. The U.S. economy is already on a solid expansion, but the new administration wants to do large-scale spending. That could surely boost inflation and U.S. bond yields, said Norihiro Fujito, senior investment strategist at Mitsubishi UFJ Morgan Stanley Securities.
GM share falls after report of China trade action. Shares of General Motors fell Wednesday after a Chinese government-run newspaper reported that the government will penalize a U.S. automaker soon for alleged anti-competitive behavior. The China Daily didn't identify the company but quoted the government's top price regulators as saying the automaker would be fined for impeding competition. GM stock fell $1.41 or 3.77% to closest at $35.95 a share. The story appeared on the day a Chinese government spokesman said any change in U.S. policy towards Taiwan will damage stability in the region. Over the weekend, President-elect Donald Trump said he didn't feel bound to recognize Beijing as China's sole government. The China Daily quoted Zhang Handong, director of the National Development and Reforms Commission Price Supervision Bureau, as saying investigators had found that a U.S. auto company had instructed distributors to fix prices starting in 2014. China has fined other foreign automakers 6 times since 2011 when it began a series of investigators of pricing practices. Volkswagen's Audi was fined $40.5 million, and Fiat Chrysler received a similar penalty on charges they suppressed competition. An official cited by government media said Mercedes also violated the law, but no penalty was announced. Linda Lim, a Chinese expert and professor of business strategy at the University of Michigan's Ross School of Business, said several factors may be at play. If you don't have the Trump phone call to Taiwan, this might have happened anyway. Lim said car prices in China have been falling for a while now because of the weaker economy. Sounds to me like they don't want to get caught in doing something they weren't supposed to be.